Hi everyone, I'm Brandon Averill, one of the partners at AWM, where we advise people in creating multi-generational flourishing families so that we can solve that shirt sleeves to shirt sleeves financial epidemic. And this is a front row seat with AWM's Chief Investment Officer, Justin Dyer, and myself, as we discuss some of our clients' most pressing financial questions. This is AWM Insights, and let's dive right in. Well, Justin, welcome back. We got, first podcast in the new office, so get the technical difficulties out of the way. Just warning everybody if we've got a little noise vibration, that's what we're dealing with here. But it's the end of the quarter, and figured we might take a little deviation from our kind of consistent theme here of trying to walk through some of the investing fundamentals and tune into what happened in this past quarter. There's definitely some headlines that are out there, and we just thought we'd address them for all the listeners here. Talk a little bit about how we think about things and how to go through it. So we saw January, U.S. stocks were at all-time highs. Things were just looking unbelievable. And then, unfortunately, we've had a slump since then and ended up with negative returns pretty much across the board in the first quarter. And, we've looked at this, and investors, there's all these worrisome headlines. They're just dominating the news channels right now. The talking heads are probably loving this because ratings are through the roof. But, we've seen things like inflation's hitting its fastest clip since 1982. Giant stock swings send some into bear territory. The Fed's set to start increasing rates in mid-March. That came out in late January. So we start to see all these headlines, Justin, and then we start to see the returns behind it, that we did have a rough quarter. We start to wonder, at least it's natural to start to wonder, hey, if inflation is printing this high, is that negative for me as an investor? How do I combat that? Should I combat that? Stocks are down. Should I just be throwing the baby out with the bathwater? Should I sell out? Should I change up my portfolio? I think most people probably know what our answer is going to be, but maybe give us a little color on when we start to see these things pop up, and these aren't totally crazy headlines that are worries we shouldn't be worrying about. They do take some planning. So I'd just love for maybe you to comment through on, hey, given the current environment and what's happening, what should we be doing, if anything?
It's a layup of a question, man. In all seriousness, I want to start with a pretty easy answer to that question, which is if you're reacting to this, or your philosophy is such that a little bit of market adversity causes you to change your entire game plan when it comes to your portfolio, your investments, you weren't doing it right to begin with. Any solid philosophy should have a plan in place to deal with adversity. Just full stop. And when that adversity hits, because it will hit, you can't all of a sudden change that plan because you become uncomfortable or because the talking heads online are saying something new. It is the time and place to be disciplined for that plan, for that practice to really take hold. And honestly, this is where the bulk of value can be gleaned over the long term if you quote stay in your seat. I was actually at a conference earlier this week, and there is a guy who had a presentation literally called that "stay in your seat," because if you look at the long term, markets climb a wall of worry. Brandon, you hit on a couple things that have been going on in this first quarter. This is kind of a little microcosm of what I'm talking about here. And clearly markets have pulled back a little bit from their all-time highs over the first quarter, down mid-single digits really across the board, whether that's in the US, developed international, emerging markets, real estate, and even fixed income. Because, as we've heard, inflation's higher, interest rates have spiked, and that's been a headwind for a lot of markets. But that is normal. This is part of the expected game of investing, if you will, the uncertainty that just exists, the volatility that we know happens within markets is why you expect a healthy rate of return over the long term. You are putting your capital at risk. Like all of these buzzwords that we might hit on, or that you might read in the financial press about uncertainty, capital at risk, et cetera, et cetera. These are the periods of time, while difficult potentially to see some of these numbers, like, you never want to see negative numbers, but it's why we expect positive returns above inflation, positive returns above, a treasury bond, whatever it may be. It's why there's a reward for long-term investing in equity or risky type assets. So, let's start there, or really you can start and kind of end there. I mean, it is truly the answer. You want to have a plan in place that acknowledges, hey, on a daily basis, it's roughly a flip of a coin. It's slightly positive that markets will be positive on any given day. Fast forward that to a month, it becomes roughly 2/3 positive, 1/3, or excuse, not 2/3. In that ballpark, between 2/3 and 3/4 positive, and 1/3 and 1/4 negative. And then you extrapolate that over to an annual basis. We get a little bit more certainty that most years are positive. But there's a very real chance that a given month or a given quarter or even a given year is going to experience a negative return. And this most recent quarter is no different.
Yeah, I think that's a good point, Justin. I mean, it's no secret, right? We're talking about it. We had a tougher quarter, a tougher 90 days. And it's natural, like we talked about, it's natural to start to, get a little worried, to at least start to question, hey, am I doing the right thing? And like you said, I mean, even with this last 90 days taken into account, you start to look at the 1-year returns, right? The 1-year returns are across the stock market pretty much positive. When you go out to 5 years, they're positive across the stock market and the bond market. 10 years, again, it's even more positive. So, you start to look at this extrapolation, and let's think about all the things that have happened in the last 10 years, right? Like all the things that we've had. COVID, we've had, ups and downs geopolitically, like we've had an invasion of Ukraine. There are a million things that have happened over the last 10 years. And yet, if we would have just stayed the course, reduced that noise, we'd have a positive outcome. And, the other question I often get from clients or people that I'm talking to is, oh, that's well and good, but what if we would have actually timed this thing right? Let's go to the timing deal, right? Like if we look at the evidence there, or lack of evidence, but let's trick ourselves into thinking that there's some evidence that we actually could. But even in the, I thought there was a good stat, and we were talking about this before we started, Justin. If there was a study done, a perfect timing strategy, and this was done from 1972 through December of 2021, and it was if you had $1,000 and I think they called them like perfect Tommy, picked every single perfect time to move in and out of the market, that $1,000 over that period would have grown to 1.8 million. Absolutely astonishing, right? If you were able to pull that off. The flip side, though, is if you were absolutely awful at picking the timing there, you'd have ended up with $949. So we've got a pretty big deviation. We know that people can't be perfect. People probably aren't going to get it absolutely wrong, but do you want to have a stream of outcomes in that scenario? No, I don't think anybody would want that. And I think, there are just things that pop up, right? There are events that we cannot foresee. I don't care who you are. Nobody has that crystal ball to look for certain events. And when those big events happen, it's typically the ones that just wash everybody out. When we look at the evidence, it time and time again tells us that you cannot continue to time the market. And I think this is even more evidenced by there is a segment of people out there that do believe they can move in and out of things. They're called tactical asset allocators. And Morningstar recently did a report on these managers to figure out, hey, maybe there are some indicators that we can move to bonds or move to cash or move to equities at different times and actually create some alpha or some benefit for our investors. Unfortunately, the data just doesn't support it. What we saw is over the 3 years time frame, so this is ending August of 2021, over 3 years, those people cost their investors 2.13% per year. You go out 5 years, they cost them 1.5% per year. And you go out 10 years, that 10-year mark that we've been kind of hitting on, they cost their investors 2.75% per year. That is astonishing. And on top of that, you're probably paying these people a lot of money to do that. So, anyways, I know I went on a little bit of a rant there, but I think at the end of the day, you hit on the head. You got to have a plan. And if you have the right plan, you can start to deal with some of these maybe inflation or rising rate impacts.
And I want to dig into that a little bit too. How should we think about that given the current set of circumstances that we're experiencing? Inflation probably being the one that's potentially top of mind. Maybe the Ukraine war, geopolitical events. But let's start with inflation. That's been a hot topic for some time now. And if you go and look at the data, there's two ways to think about it. Do you want to outpace inflation, or do you just want to protect or hedge yourself against unexpected inflation? Most investments will keep up with expected inflation over long periods of time. When we experience periods of unexpected inflation, I'm really emphasizing that because that's essentially what happened right now. All of a sudden, some people telegraphed it. Some people thought, oh, the system is awash with money and whatnot, where we should expect inflation. No one can necessarily again predict that future time and time again, but we're experiencing inflation right now. It was unexpected by the market, is how to think about it in this context. And so the way we think about that is there are certain priorities that are unique to each and every individual that are incredibly important to make sure at a minimum we keep up with inflation. Unexpected inflation, again, making sure we hit on the difference there, where these are things that are important needs over the relatively short period of time to intermediate period of time. Hey, we need, $10,000 a month to live on for the next 10, 15, 20 years. We don't really want to take a bunch of risk with that and put that type of money into equity markets, but we still want to make sure that is hedged to keep up with unexpected inflation. So there are tools out there in the market called inflation-protected securities. TIPS is another term that you might hear. And so we build our portfolios based on your custom priorities and match those priorities and the value of them to an inflation-protected type portfolio. Trying to keep things really high level here, but that's one way to think about that. That hedges unexpected inflation and makes sure your purchasing power, your ability to maintain that quality of life, is protected for a relatively long period of time. Maybe it's shorter for you, maybe it's longer for others, but again, just kind of trying to keep it high level. And then on the flip side, it's outpacing inflation. And we've touched on this at various times throughout this podcast. One of the best ways to keep up with or outpace inflation, is in the equity market. It doesn't mean quarter over quarter, month over month, that there's going to be lockstep movement between the equity markets and what we see with the inflation data. Doesn't mean that whatsoever. It means over long periods of time, equities, stocks, outpace inflation quite handsomely for a lot of the reasons I touched on earlier, right? You are being rewarded for risking your capital, for the uncertainty that exists, to have these geopolitical events somewhat come out of left field, right? That is just the playing field that exists. There are going to be future crises, and kind of by definition, that's the uncertainty that often comes up through the form of some sort of crisis. Not always, but often. And by definition, a crisis is is called a crisis because no one really thought about it beforehand, so it's inherently unpredictable. So I think just trying to hopefully tie a bow on all this, where we said, hey, having a plan beforehand, having a portfolio in place that deals with situations like we're seeing right now, that's critical. And then tying that to some tangible examples about how we actually think about that for you all as long-term investors.
Yeah, and I think to get somewhat nuanced on that, Justin, I think this goes back to why you should have a very personalized plan, right? Because if you don't have a personalized plan, some advisors throwing you into a 70-30 portfolio, 30% of your portfolio is tied to fixed income and bonds, for instance. And in a rising inflation environment, yeah, there's some protection there potentially. But if that portfolio, maybe that allocation to bonds is far too large or potentially too small, but the point is that you're giving something up there. Let's say that you only need 20% for your priorities. Now you have 10% that is getting eroded by that inflation when it should be in the stock market. It should be in portfolio growth to outpace that inflation rate. So, I think, and it could certainly go to the flip side. I think the point here is having that plan, but making sure that it's also very, very customized to your priorities. And I think this also, for those, DIY or do-it-yourself investors out there that are listening to this potentially, I think that's also a question you got to ask yourself, is really wrestle through those things and make sure that you're adjusting your portfolio and think about the difficulties of potentially doing that. I think that's certainly a great mark for why you would include an advisor, somebody that's paying attention to that on a very regular basis and helping you to work through those priorities. So, we certainly have had a rougher quarter when you look at a return perspective, but we certainly encourage everybody to take a step back, look broader, look longer term, make sure you have that financial structure in place. Because if you have that protective reserve, that essential spending priority allocation set aside, all of this is just noise that you should be ignoring and not worrying about. This is just part of the process. You hit on it, Justin. It's why we get rewarded to be investors. So, some of the key takeaways, actionable things for you this week: tune out the noise. This is all noise if you have the proper financial structure in place, which is key takeaway number 2. Look at your portfolio. Make sure that it's matched up to your priorities. If it's not, pick up the phone, call your advisor. They're not mind readers. Sometimes they need to be cued into things that have changed in your life. Help them to make sure that it is tied to your priorities. And then the last thing is just rely on the evidence. So as you're looking at your portfolio, what's in there, think about what the evidence actually says rather than the sexy sales pitch. It's a heck of a lot easier for most people to sell the predictive model that gets to our croc brain, right? That we think we can outsmart things. But go back to the evidence, and the evidence tells us to just have a plan, tune out the noise, and be diversified. So with that, we're going to close on out for this week, but would love to hear from you. As you know, you can text me, comes directly to me. That number again is 602-704-5574. If you shoot me a text, you include the light bulb emoji or the AWM insights. We're going to be giving away some swag, as I mentioned before, but would also love to get your questions via that kind of avenue. And we'd just love to hear from you and be able to stay in touch. So again, that number is 602-704-5574. And until next time, own your wealth, make an impact, and always be a pro.
The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.